Hey, what's up YouTube? This is Casey here. Just thought I would shoot another video. Today is May 13th, 2016. And today's video I wanted to talk about staying the course, alright, when it comes to investing. And that has a lot to do with, the fear-mongering and people out there, saying that it's doomsday, get out of the stock market, don't invest in it, it's not, it's not good, there's too much corruption, politics, politicians controlling everything, you're not going to make any money, whatever. I've heard just about everything, from multiple individuals out there on mainstream media talking about, how it's the worst thing in the world to invest right now, and you're going to lose all your money. Well, that's partially true if you don't know what you're doing. If you're not doing any research or reading books or putting your own money on the table to learn from your own mistakes, then yes, you're going to lose a lot of money in your lifetime. But that's one of the reasons why I'm shooting this video, is to help you guys out and share with you my experience so far and some of the mistakes I've made, so that you don't have to make the same mistakes. All right, you can save some of your money in the long run. When it comes to investing. Now, I'm talking about the long run or the long term in investing here, and since I'm bringing that up, I wanted to share a quote with you real quick that I heard from Warren Buffett. All right, and it was in one of his interviews. I can't remember the exact date when he said this, but I wrote it down, and it has a lot of truth to it, just based off my own experience so far, and comparing his quote to my own experience, it just kind of, it opened my eyes, took the blindfold off a little bit more when it comes to the truth behind investing and building wealth. The quote's a pretty good one here. It's, "The stock market is designed to transfer money from the active to the patient." All right, and that's Warren Buffett. Pretty much one of the greatest investors of all time. Alright, now what does he mean by that? Transferring money from the active to the patient? Well, if you went back and you watched some of my videos on long-term investing and asset allocation, you know then that basically what it comes down to is being patient, having a long-term plan, instead of letting your emotions play into whatever decision making that might take place when you're investing. Alright, because we all know emotions will get the best of you every single time. Alright, take it from me, I've learned that over the past 3 or 4 years, just making silly mistakes here and there day trading. Okay, but then there again, I was day trading. Alright, I was being an active investor. Okay, so that's what Warren Buffett is talking about here, is you're going to make mistakes being an active investor, more so than you will, if you're being a passive or a defensive investor. Okay, and then the reason why is because you're thinking short term as an active investor, and that allows, that basically, it doesn't allow, but it's one of those things where when you're active, investing, your emotions can get the best of you a lot quicker, okay? And you won't even realize it until it's happened and you've lost a lot of money. Alright, now, with in regards to talking about being an active investor and being patient, I want to cover another topic with you real quick, because it kind of plays into this whole quote that Warren Buffett is famous for saying. And it's called dollar cost averaging. Alright, I'll write it down here for you. Dollar cost averaging. Now, if you're new to investing, you might be wondering, well, what the hell does that mean? And I'm going to explain it here real quick for you. Dollar cost averaging, it has a lot to do with dividends being reinvested. So if you, let's say you're investing in a company, you have dividends attached to that company, with your stock that you own, they're going to pay you out a certain percentage, each month or quarterly or maybe annually, and you're going to get a paycheck from them just for investing with them. Okay, dollar cost averaging kind of plays into that, and it also is aligned with the long-term approach when it comes to investing. So basically, the easiest way to explain it to you here, I'm going to have to kind of demonstrate or give you an example of how this works. So let's say you got the share price, all right, of a company, and we all know that share price, it's going to go up and down, right? I mean, that's inevitable. You can't fight that. So if your share price is going up and down like this throughout time, that's okay. We'll just say this is within a 10-year time frame. 10 years, sorry. So your share price is going up and down. Now dollar cost averaging will play into this because let's say when you first make your initial investment, let's just say, hold on here. Let's just say you make that investment like right around in here somewhere, okay? Well, let's say that the share price at that point in time is, I don't know, $50, okay? Now, dollar cost averaging will come into play in the long term over this 10-year time frame because let's say this share price or this stock is paying out a dividend, I don't know, every 3 months, okay, every quarterly. And quarterly, it's going to pay you, and if you have it set up on a drip formula, so it's reinvesting your dividends, that means you're buying up more shares of the company that you own, okay? Now, when that happens, when that happens and you're reinvesting those dividends, it doesn't matter what the share price is, okay? So let's say here, 3 months later, they pay out a dividend to you. Your share price could be down here, okay? And it could be, I don't know, let's just say $48 instead of $50. Okay, see it's dropping here. Your reinvested dividends are now buying in a lower price, which is a good thing for you because if you're looking at buying something, do you want to buy higher in price or lower in price? You always want to buy lower, right? You always want that discount. Well, that's what dollar cost averaging gives you is a little bit of leverage through your reinvested dividends to go ahead and buy in at lower prices when the stock price is going down. Now that doesn't always happen. Your share price can go up and you could pay more than say $50 when you first originally made your investment. The point is though, the money that is buying up more shares is not your money. It's other people's money, okay? Which is awesome too because you don't have to fork money out of your own pocket to grow your wealth, okay? So hopefully that makes sense for you guys, and that's why I really, when I'm investing, I don't really pay attention to the share price too much. And as far as an exit plan, my exit plan has kind of changed a little bit with long-term investing. As I've gotten wiser and a little bit smarter. Basically, here's what I do. I look at it just like Warren Buffett looks at it. If you're making an investment into a company and it's paying out a dividend to you, all right, it's kind of like a house. You're buying a house. If your realtor comes up to you after you bought your house 2 months later and says it's lost, 5% or 1% in value, you're not going to turn around and sell your house. You're not going to do that. You're just going to probably shrug it off and be like, okay, fine, whatever. I'm going to hold out and wait for the value of my home to go up. Well, you do the same thing with your stocks. You need to treat your stocks the same way as you would your house. Okay? And rule of thumb for guys like Warren Buffett and Carl Icahn, Ray Dalio, guys like the guys at the top, they'll tell you, and if you just go in and listen to some of their interviews when they're talking about investing for the long term, they'll tell you straight up that if you're going to make an investment into something, you should probably look at holding on to it for at least 10 years. At least 10 years, because you're buying in on an asset. Okay, it's a paper asset, so it may not have as much value as, say, a tangible asset like a house that you physically own, or something like gold or silver if the price is going up big time due to fear in the markets. So it's a little bit different than tangible assets, but it's still an asset because it's paying you. All right, and you want to hold on to it regardless of what happens in the markets, regardless of what people are saying when it comes to, get your money out of the markets now, this and that. Because guess what? If the markets are going down, they're always going to go down. Of course, we all know that throughout time. All you have to do is just go do a little research on the history of stocks. All right, we've had, just in the last 100 years, we've had, I don't know, probably 6 to 8 major stock crashes. All right? So it happens, is what I'm trying to say here. It happens all the time. So for them to come out and start fear-mongering because the stock market's going to crash again, well, guess what? I mean, of course, duh. And guess what? The stock market's going to go back up too. So just keep that in mind. It helps you control your emotions a little bit in long-term investing. And if you can stay in like that, you're going to take advantage of the dollar cost averaging. You'll build your wealth over time. And that'll keep you from doing what most people do, which is selling due to fear in the markets and people fear mongering and scaring them into believing that you need to get out of the stock market right away because it's not going to exist here 6 months from now. All right, and if you can stay in like that, here 2 or 3 years from now, and your friend Roger is telling you to sell, he went ahead and sold and lost his money due to letting his emotions take control of him and get the best of him. He's going to come back to you later when you're still in and you're riding the new bull market that takes place. All right, and guess what? Roger will probably do the same thing, but he's going to be late to the party where you stayed in, so you're going to be able to basically get in at the right time, or you'll be in at the right time. And that will be when the prices are very low and they're going up. Okay? So you're going to probably, staying in, you're going to make more money than Roger. Especially if Roger's an active investor. I can almost guarantee it. But with that being said, that's pretty much what I wanted to cover with you guys. Today was, just stay in the course. Forget about the fear-mongering. Don't listen to it. Change the station. Listen. Think positive. Okay? Because the thing is, the stock market, I don't think it's going anywhere anytime soon. Money or currencies, they might change throughout time. Monetary policies might change. Interest rates might change. But you're still going to have some type of a market in place. And I just don't see the stock market not existing here in a couple of years. I just don't. Because I'm not a doom and gloom type guy. And I know there's a lot of crazy stuff going on